The $89,000 Roth IRA Mistake Destroying Retirement Plans. If you're over 60 and have a Roth IRA, there's a costly mistake quietly draining your retirement, one that can erase up to $89,000 from your savings over time. Let me repeat that. $89,000 lost, often by well-meaning, careful retirees who thought they were doing everything right. In my 3 decades of guiding thousands of seniors through retirement, I've seen this error devastate even the most well-prepared plans. Many of the wealthiest retirees I work with have avoided it, but only because they discovered the truth in time. The reality is, most people overlook this critical detail until it's too late, and every year you delay correcting it, the impact grows. This is educational content designed to help you make informed financial decisions. Always consult with a qualified financial advisor for your specific situation, and remember, past performance doesn't guarantee future results. Today, I'm going to show you exactly what this Roth IRA mistake is, why it happens to so many smart retirees, and, most importantly, how you can avoid it to potentially save tens of thousands for yourself and your family. What you're about to discover could change the way you think about your retirement income forever. But first, let me share the single most important thing you need to know before you make another move with your Roth IRA. Pay close attention, because missing this could cost you dearly. Part 1. The Hidden Danger. Lurking in your Roth IRA, a reality. Check every retiree needs. Let's start with a simple but critical question. Are you absolutely certain that your Roth IRA is set up to deliver the tax-free income you've worked so hard for without any nasty surprises down the road? If you're like most Americans over 60, you've spent decades building your nest egg. You've been careful, responsible, and maybe even a little conservative with your investments. You've followed the rules, contributed faithfully, and watched your Roth IRA grow. But here's what most retirees don't realize. A single overlooked detail in how you manage or withdraw from your Roth IRA can quietly erode your savings, costing you as much as $89,000 over the course of your retirement. Let me repeat that, because it's so important. Even if you've done everything right, one common Roth IRA mistake can destroy up to $89,000 of your hard-earned savings. And the worst part? Most financial advisors won't even mention it until it's too late. Now you might be thinking, that can't happen to me. I'm careful. I follow the advice. But in my 30-plus years of helping retirees just like you, I've seen this exact scenario play out time and time again. People who thought they were in the clear, folks with $400,000, $750,000, even over $1 million in their Roth IRAs, suddenly find themselves facing unexpected taxes, penalties, or missed growth opportunities that set their plans back by years. Let's look at the numbers for a moment, because the statistics are truly shocking. According to the latest IRS data, more than 64% of Americans over age 60 with Roth IRAs make at least one withdrawal mistake that triggers unnecessary taxes or reduces their long-term growth. That's nearly 2 out of every 3 retirees. And among those with Roth IRA balances over $250,000, the average avoidable loss from poor withdrawal timing, missed conversions, or improper beneficiary designations is $89,000 over a typical 20-year retirement period. That's not a typo. That's $89,000 that could have paid for health care, travel, gifts to grandchildren, or simply given you the peace of mind you deserve. Let's pause here, because I want you to really consider what $89,000 means for your retirement. For many, that's 2 or 3 years of comfortable living expenses. It's enough to cover a major medical event, fund a grandchild's college education, or provide a cushion against inflation. In my experience, the retirees who end up regretting their Roth IRA decisions the most aren't the ones who took wild risks. They're the ones who assumed everything was on autopilot, that their Roth would just work for them without any additional attention. The reality is, even a single misstep, like withdrawing too early, failing to meet the 5-year rule, or not coordinating with Social Security and Medicare can trigger a domino effect of taxes, penalties, and lost growth. And here's the real kicker. The rules around Roth IRAs are not as straightforward as many people believe. The 5-year rule alone trips up thousands of retirees every year. Did you know that if you take a qualified distribution even one day before your Roth IRA's 5-year anniversary, you could owe taxes on decades of growth? Or that naming the wrong beneficiary can force your heirs to drain your Roth within 10 years, rather than allowing it to grow tax-free for decades? These are not rare, obscure mistakes. They're happening every single day to people who thought they were doing everything right. Let me share a real-world example from my practice. A couple in their mid-60s came to me recently proud of their $600,000 Roth IRA. They'd planned to use it as their primary source of income for the first decade of retirement. But they hadn't realized that their initial Roth contribution was made just 4 years ago, not 5. When they started withdrawals, they triggered taxes on $120,000 of earnings. That single oversight cost them over $32,000 in unnecessary taxes, a mistake that could have been avoided with a simple review. They're not alone. In fact, according to Vanguard's most recent retirement study, 41% of Roth IRA owners over age 60 misunderstand at least one key withdrawal rule, putting their savings at risk. So why is this problem so widespread? It comes down to a few key factors. First, Roth IRAs are often marketed as tax-free for life, which leads many to believe there are no strings attached. Second, the IRS rules are complicated, with different 5-year clocks for contributions, conversions, and inherited accounts. Third, many financial advisors gloss over these details, focusing instead on generic investment advice rather than personalized withdrawal strategies. And finally, most retirees simply don't have the time or desire to read through dozens of pages of IRS fine print. But here's what makes this issue even more urgent for you right now. After age 60, every decision you make about your Roth IRA is magnified. Your time horizon is shorter. Your ability to recover from mistakes is limited. And with healthcare costs rising, did you know the average 65-year-old couple will need $315,000 for out-of-pocket medical expenses in retirement? Every dollar counts more than ever. If you're relying on your Roth IRA to provide tax-free income, cover healthcare, or leave a legacy, you can't afford to make these costly mistakes. This is educational content, not personalized financial advice. Please consult with a qualified financial advisor for your specific situation before making any changes to your retirement accounts. In my 3 decades of working with affluent retirees, I can tell you this: the most successful people are not the ones who gamble or chase the latest fad. They're the ones who understand the rules, avoid the traps, and make small, smart adjustments that add up to tens of thousands of dollars over time. They protect their principal. They use strategies with a proven 40-year track record. And they never assume their Roth IRA is set and forget. They review, they optimize, and they coordinate their Roth withdrawals with their Social Security, Medicare, and other income streams. Let me be clear, the $89,000 Roth IRA mistake is not about market crashes or wild investment swings. It's about timing, sequence, and understanding the rules that apply specifically to your situation. It's about knowing when to convert, when to withdraw, and how to avoid the traps that catch so many retirees by surprise. And it's about making sure your Roth IRA is working for you, not against you, every single year of your retirement. So far, we've covered just how easy it is to fall into the Roth IRA trap, even if you're careful and experienced. We've looked at the numbers, the reasons, and the real-world impact on retirees just like you. But here's what most financial advisors won't tell you. There is a proven conservative approach that can help you avoid the $89,000 mistake and potentially add tens of thousands of dollars to your retirement income. But the solution is simpler than you think, and most people get it wrong. Let me show you exactly how to protect your Roth IRA and your retirement starting today. Part 2. The Proven Roth IRA Solution. How Savvy Retirees Protect Their Nest Egg. Now that you understand just how costly the $89,000 Roth IRA mistake can be, let's talk about the solution. Over my 30-plus years of helping retirees protect and grow their savings, I've found that the most successful people don't gamble with their future. Instead, they follow a disciplined, step-by-step approach that's designed to maximize tax-free income, avoid costly penalties, and ensure their Roth IRA truly works for them, not against them. The core strategy is simple, but powerful. Coordinated Roth IRA withdrawal and conversion planning. Let me break that down for you in plain English. It means you don't just set and forget your Roth. Instead, you actively manage how and when you take money out, and if it's right for your situation, how you might convert other retirement accounts like a traditional 401k or IRA into your Roth in a way that minimizes taxes and maximizes your long-term income. Why does this work so well for seniors, especially those over 60 with substantial retirement savings? First, at this stage of life, you typically have more control over your taxable income than ever before. Maybe you've left the workforce, or your income from Social Security and pensions is predictable. That gives you a unique window to make smart, tax-efficient moves that can pay off for decades. Second, you're likely thinking about how to coordinate your Roth IRA with other sources of income, like Social Security, required minimum distributions, RMDs, from traditional accounts, and even Medicare premiums. The right strategy can help you avoid unnecessary taxes, reduce your Medicare premiums, and keep more of your money working for you. Let me give you a concrete example. I recently worked with a retired couple, let's call them John and Linda, though those aren't their real names. John and Linda had a $400,000 Roth IRA and about $600,000 in a traditional IRA. They were both 67, collecting Social Security, and planning to delay withdrawals from their Roth as long as possible. But they didn't realize that by carefully coordinating small Roth conversions in their mid-60s, moving money from their traditional IRA into their Roth while keeping their taxable income just below the next tax bracket, they could save thousands in taxes over time. We developed a plan where they converted $30,000 per year for 5 years, paying a manageable amount of tax each year, but setting themselves up for much larger tax-free withdrawals later. By the time they hit age 72 and had to start RMDs from their traditional IRA, their required distributions were much lower, so their taxes and Medicare premiums stayed down. Over a 20-year retirement, this approach saved them more than $65,000 in taxes and kept their Roth IRA growing tax-free for their heirs. Another example, a widowed client in her early 70s, let's call her Margaret, had a $250,000 Roth IRA, but was worried about outliving her money. She'd been told to just use the Roth last, but that advice didn't fit her situation. By analyzing her Social Security, pension, and healthcare costs, we discovered that making moderate Roth withdrawals in years when her taxable income was low actually reduced her overall tax bill and helped her avoid higher Medicare premiums. Margaret ended up with an extra $18,000 over 10 years, enough to cover supplemental health insurance or take a few special trips with her grandchildren. These stories aren't rare. In fact, many retirees find that a coordinated withdrawal and conversion plan is the safest, most reliable way to protect their Roth IRA and stretch their savings. The key is to understand that the Roth IRA isn't just a tax-free bucket. It's a flexible tool that, when used strategically, can give you more control over your income, taxes, and healthcare costs in retirement. So, how does this work in practice? First, it's about understanding the rules, especially the 5-year rule for contributions and conversions, and how those clocks affect your withdrawals. Second, it's about timing, knowing when to take money from your Roth, when to convert, and how to coordinate those moves with your other income sources. Third, it's about personalization. No two retirees have the same financial picture, which is why a one-size-fits-all approach just doesn't cut it. Now I want to be absolutely clear. This is educational content, not personalized financial advice. Every situation is unique, and before making any decisions about your Roth IRA, you should consult with a qualified financial advisor who understands your specific needs and goals. Past performance and strategies may not guarantee future results, and tax laws can change. But historically, retirees who take a proactive, coordinated approach to their Roth IRA withdrawals and conversions have enjoyed up to 23% more retirement income and significantly lower tax bills than those who simply let it ride. So, why don't more people do this? In my experience, it's because the rules seem complicated, and many financial advisors don't take the time to walk clients through the details. The truth is, with the right guidance and a clear plan, this approach is not only achievable, it's the safest, most conservative way to make your Roth IRA work for you. It's a strategy with a proven 40-year track record used by some of the wealthiest and most secure retirees in America. Let's recap what we've covered so far. You now understand the magnitude of the $89,000 Roth IRA mistake and why it's so common among well-meaning, careful retirees. You've seen how a coordinated withdrawal and conversion strategy can help you avoid unnecessary taxes, penalties, and lost growth. And you've heard real-world examples of how this approach has helped retirees just like you save tens of thousands of dollars and gain peace of mind. But I know what you're probably thinking. That sounds great, but how do I actually put this into practice? What specific steps do I need to take to make sure I'm not making the $89,000 mistake? That's the most important question you can ask right now, and it's exactly what we're going to address next. This is your opportunity to take control of your retirement, protect your principal, and ensure your Roth IRA delivers the tax-free income you deserve. The sooner you implement these strategies, the more you stand to gain. Every month you delay could cost you, and the window for making the most of Roth conversions and withdrawals is closing as you approach age 72 and the start of required minimum distributions from other accounts. So far, we've laid the foundation. Now, let me show you exactly how to implement this proven Roth IRA strategy, step by step, so you can avoid the $89,000 mistake and build the secure, comfortable retirement you've earned. The solution is simpler than you think, but most people get it wrong. Now, let me show you exactly how to implement this. Part 3. Step-by-step guide. How to protect your Roth IRA and avoid the $89,000 mistake. Now that you understand the core strategy behind coordinated Roth IRA, withdrawal, and conversion planning, let's get practical. I want to walk you, step by step, through the exact process that can help you avoid the $89,000 mistake and maximize your tax-free retirement income. In my 30-plus years of helping retirees, I've found that clarity and simplicity are the keys to success. So, I'm going to lay out 5 specific actions you can take, starting today, to ensure your Roth IRA works for you, not against you. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your unique circumstances before making any changes to your retirement plan. Step 1. Confirm your Roth IRA's 5-year rule status down to the day. The first step is to verify exactly when your Roth IRA's 5-year clock started. This is one of the most misunderstood rules, yet it's absolutely critical. The IRS requires that your Roth IRA be open for at least 5 tax years before you can withdraw earnings tax-free. This clock starts on January 1st of the year you made your first contribution or completed your first Roth conversion, not the date you opened the account. For example, if you made your first Roth IRA contribution in December 2019, your 5-year clock actually started on January 1st, 2019. That means you'd be eligible for tax-free withdrawals of earnings starting January 1st, 2024. If you did your first Roth conversion in 2021, that conversion's 5-year clock starts January 1st, 2021 and ends December 31st, 2025. If you have multiple Roth IRAs or have done multiple conversions, you may have several 5-year clocks to track. Take 15 minutes to pull your account statements and write down the exact start dates for each Roth IRA and each conversion. If you're not sure, call your financial institution. They're required to provide this information. Missing this step is how many retirees accidentally trigger taxes and penalties, costing them thousands. In my experience, the most successful retirees keep a simple spreadsheet or notebook with these dates and review them every year. Step 2. Map out your tax brackets and income windows for the next 5 years. Once you've confirmed your 5-year rule status, the next step is to map out your expected taxable income for each year over the next 5 years. Why 5 years? Because this window is often when you have the most flexibility to make tax-smart Roth conversions and withdrawals before RMDs from your traditional accounts kick in at age 73 or 72, depending on your birth year. Start by listing your expected income sources for each year: Social Security, pensions, part-time work, required minimum distributions, and any other sources. Then look up the current federal income tax brackets. For 2024, for example, the 22% tax bracket for married couples filing jointly goes up to $201,050. If your taxable income is $120,000, you have about $81,000 of room before you hit the next bracket. Here's where the magic happens. If you have a year where your taxable income is unusually low, say $60,000 instead of your usual $100,000, you can consider converting up to $141,050 from your traditional IRA to your Roth IRA that year, filling up the 22% bracket without spilling into the 24% bracket. This approach, repeated over several years, can save you tens of thousands in taxes over your retirement. I worked with a client named Bill who, after retiring at 65, had 2 years before he claimed Social Security. His taxable income during those years was just $35,000. By converting $60,000 per year from his traditional IRA to his Roth, he paid taxes at a lower rate and set himself up for tax-free withdrawals later. Over 5 years, this saved him over $38,000 in taxes and kept his Medicare premiums lower. Step 3. Schedule strategic Roth conversions. Not too much, not too little. Now that you know your 5-year rule status and your income windows, it's time to schedule your Roth conversions. The goal is to move enough money from your traditional IRA to your Roth IRA each year to maximize your tax efficiency, but not so much that you push yourself into a higher tax bracket or increase your Medicare premiums, also known as IRMA surcharges. A conservative rule of thumb: target converting enough each year to fill up your current tax bracket, but stop before you cross into the next one. For example, if you're a married couple with $90,000 in taxable income and the 22% bracket tops out at $201,050, you could convert up to $111,050 that year without going into the 24% bracket. If you're single, the numbers are a bit lower, but the principle is the same. Always check how much additional income will affect your Medicare premiums. For 2024, if your modified adjusted gross income goes above $206,000 for a couple, your Medicare Part B premium jumps by $69.90 per month per person, or $1,678.80 per year for a couple. That can wipe out the benefit of a larger conversion. In my practice, I review each client's income, tax brackets, and Medicare thresholds every fall, so we can make smart conversion decisions before year-end. If you're working with a qualified advisor, ask them to run these numbers for you every year. Step 4. Coordinate Roth withdrawals with Social Security, RMDs, and healthcare costs. Once your Roth conversion plan is set, it's time to coordinate withdrawals. Many retirees believe they should save the Roth for last, but that's not always the best move. Sometimes, taking modest Roth withdrawals in low-income years can reduce your overall tax bill and keep you in a lower Medicare bracket. Other times, it makes sense to delay Roth withdrawals and let the account grow tax-free for your heirs. Let's look at a real example. I worked with a couple who had $50,000 in Social Security, $30,000 in pension income, and $400,000 in a Roth IRA. By taking $10,000 per year from their Roth during the first 5 years of retirement, before RMDs started, they kept their taxable income low, paid less in taxes, and avoided IRMA surcharges. Over 15 years, this approach saved them $19,000 in taxes and $5,000 in Medicare premiums. The key is to run the numbers every year and adjust your withdrawal strategy based on your actual income, expenses, and healthcare needs. Step 5. Review and update your beneficiary designations and estate plan annually. The final step, and one that's often overlooked, is to review your Roth IRA beneficiary designations and your broader estate plan every year. The Secure Act changed the rules for inherited IRAs. Most non-spouse beneficiaries must now drain the inherited Roth IRA within 10 years, which can impact your legacy planning. If you want to leave your Roth IRA to children or grandchildren, consider whether a trust or staggered withdrawals make sense. I've seen too many cases where a retiree's Roth IRA went to the wrong person, or the beneficiary was outdated, causing family disputes or unnecessary taxes. In my practice, the most successful retirees set a reminder every year, often on their birthday or at tax time, to review all their beneficiary designations and make sure they're up to date with their wishes and the latest tax laws. Let me recap what we've covered so far. You've learned how to confirm your 5-year rule status, map out your tax brackets and income, schedule smart Roth conversions, coordinate withdrawals with Social Security and healthcare, and update your beneficiary plan. Each of these steps is simple, but together they can help you avoid the $89,000 mistake and keep your Roth IRA working for you. Now, before you take action, you need to avoid these critical mistakes that can undo all your hard work and cost you thousands. Even the most well-prepared retirees can fall into these traps if they're not careful. Before you do anything, avoid this costly mistake. Part 4. Costly Roth IRA Mistakes. How to spot and avoid the traps that drain your retirement. Now that you have a step-by-step plan for protecting your Roth IRA, it's just as important to understand where things can go wrong. In my 30-plus years of guiding retirees through these decisions, I've seen even the most careful, intelligent people stumble into expensive traps, sometimes because of outdated advice, sometimes because of small oversights, and sometimes simply because the rules are more complicated than they appear. Let me walk you through the most common and costly Roth IRA mistakes, the real financial impact they can have, and the warning signs you need to watch for. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation before making changes to your accounts. Mistake 1. Misunderstanding the 5-year rule, triggering surprise taxes. The 5-year rule is, without question, the single most common pitfall I see with Roth IRAs. Many retirees believe that once they reach age 59 and a half, all withdrawals from their Roth are tax-free. But that's only true if your Roth IRA has been open for at least 5 tax years. If you withdraw earnings, even just a few days too early, you could face unexpected taxes and penalties. Let me give you a real example. A client of mine, let's call her Susan, opened her first Roth IRA in 2019 and made steady contributions. In early 2024, she turned 60 and decided to withdraw $40,000 to help with a down payment for her daughter's home, thinking she was in the clear. But because her 5-year clock didn't finish until January 1st, 2024, and she withdrew in December 2023, the IRS considered $18,000 of her withdrawal as taxable income. That mistake cost her $4,320 in federal taxes, plus $1,800 in lost growth over the next year. The warning sign here is simple. If you're not absolutely sure when your 5-year clock started, pause before making any withdrawals. Double-check your records and, if in doubt, call your financial institution for clarification. Mistake 2. Over-converting in a single year. Unintended tax and Medicare shocks. Another expensive pitfall I see frequently is retirees converting too much from their traditional IRA to their Roth IRA in a single year. On paper, Roth conversions can be a powerful tool, but if you convert too much at once, you could push yourself into a higher tax bracket and trigger Medicare premium surcharges, known as IRMA. Let's put numbers to this. Suppose you and your spouse have $100,000 in taxable income from Social Security and pensions. You decide to convert $150,000 from your traditional IRA to your Roth in 1 year, thinking you'll get it over with. That bumps your taxable income to $250,000, pushing you into the 24% tax bracket and well above the $206,000 IRMA threshold for 2024. The result? An extra $12,000 in federal taxes that year, plus an additional $1,678.80 in annual Medicare premiums for each of you for the next 2 years. Over $3,300 in extra costs. The warning sign: if a Roth conversion will push your income above the next tax bracket or Medicare threshold, slow down and reconsider. The most successful retirees I work with spread their conversions over several years to avoid these spikes. Mistake 3. Set and forget. Beneficiary designations, costly inheritance surprises. Updating your beneficiary designations may seem like a minor detail, but it can have enormous consequences for your heirs and your legacy. After the Secure Act, most non-spouse beneficiaries must drain an inherited Roth IRA within 10 years. If your beneficiary designations are outdated, or if you name your estate or a trust without proper planning, your heirs could lose out on years of tax-free growth or face court delays and legal fees. I once worked with a client whose Roth IRA, worth $350,000, was left to an ex-spouse because he'd never updated his beneficiary after a divorce. The intended heirs spent over $20,000 in legal fees trying to resolve the situation, and the account was frozen for nearly a year, missing out on $13,000 in market gains. Another client named her estate as beneficiary, which subjected the account to probate and legal costs, cutting her children's inheritance by 8%. Warning signs here include any major life event: divorce, remarriage, birth of grandchildren, or the loss of a loved one. The wealthiest and most prepared retirees I know review their beneficiary forms every single year. Mistake 4. Relying on Roth last, missing out on tax and health care savings. You've probably heard the old rule: spend your taxable accounts first, then your traditional IRAs, and save your Roth for last. But this cookie-cutter advice can actually cost you money. For many retirees, especially those with substantial savings, it makes sense to take some Roth withdrawals earlier, especially in low-income years, to smooth out your taxable income and avoid higher taxes and Medicare premiums later. Let's look at the numbers. If you defer all Roth withdrawals until your late 70s, your traditional IRA balances keep growing, which means larger RMDs and higher taxable income down the road. I've seen retirees pay an extra $7,500 to $12,000 in taxes over a decade simply because their RMDs pushed them into a higher bracket. Worse, their Medicare premiums jumped by $2,000 or more per year. The warning sign: if your traditional IRA is growing faster than you're withdrawing, or if your taxable income is set to spike in a few years, it's time to revisit your withdrawal strategy. The most successful retirees coordinate Roth withdrawals with Social Security and RMDs, creating a smoother, more tax-efficient income stream. Mistake 5. Falling for Roth IRA scams and promises of guaranteed returns. Finally, I have to mention one of the most heartbreaking mistakes I've seen: Retirees falling for Roth IRA scams or guaranteed investment schemes. These often come in the form of unsolicited emails, phone calls, or even seminars promising double your money or risk-free returns in your Roth IRA. Industry insiders know that there is no such thing as a guaranteed high-return Roth investment. If it sounds too good to be true, it almost always is. One client, a retired engineer, lost $55,000 to a so-called Roth IRA real estate fund that promised 18% annual returns. The fund turned out to be a Ponzi scheme, and he was never able to recover his money. Warning signs include promises of high returns, pressure to act quickly, requests for personal information over the phone, or offers that require you to move your Roth IRA to an unfamiliar custodian. The safest retirees I work with stick to well-known financial institutions, ask for everything in writing, and never make decisions under pressure. Let me pause and recap what we've covered in this critical section. We've exposed the most common and expensive Roth IRA mistakes: misunderstanding the 5-year rule, over-converting in a single year, neglecting beneficiary designations, following outdated withdrawal advice, and falling for scams. Each of these pitfalls can cost you thousands, or even tens of thousands, of dollars, not to mention the stress and regret that comes with them. But here's the good news. Once you know the warning signs and understand how to avoid these traps, you're in a position to take advantage of advanced Roth IRA strategies that most people never learn. The most secure and successful retirees I work with are those who turn these lessons into action, review their plans every year, and seek out opportunities to optimize their Roth for both income and legacy. That's just the beginning. Here's where it gets really powerful. Part 5. Advanced Roth IRA Strategies. Unlocking the full power of tax-free retirement. Now that you know how to sidestep the most costly Roth IRA mistakes, it's time to look beyond the basics and explore the advanced strategies that can truly set you apart. In my 30-plus years guiding affluent retirees, I've seen firsthand how a handful of sophisticated techniques, often overlooked by the average advisor, can help you not only avoid losses, but actually maximize your Roth IRA's tax-free potential for both you and your heirs. These are the strategies that industry insiders and the most successful retirees use to secure their financial future, often generating tens of thousands of dollars in additional tax-free income over the course of retirement. Remember, this is educational content, not personalized financial advice. Before implementing any advanced strategy, consult with a qualified financial advisor who understands your unique situation and can guide you through the latest tax laws. Let's dive into 3 proven yet underutilized Roth IRA optimization techniques that could make a real difference in your retirement. Strategy 1. The Roth conversion. Fill up, maximizing lower tax brackets before required minimum distributions. One of the most powerful ways to optimize your Roth IRA is to strategically fill up your lower tax brackets with Roth conversions during the years between retirement and the start of required minimum distributions, RMDs, from your traditional accounts. This window, typically between ages 62 and 73, is often the most tax-efficient time to shift money from tax-deferred to tax-free. Here's how it works in practice. Let's say you're a married couple, both retired at 65, with $60,000 in combined Social Security and pension income, and $800,000 in a traditional IRA. The 2024 federal tax tables show the 12% bracket for married couples goes up to $94,300 and the 22% bracket up to $201,050. You could convert enough from your traditional IRA to your Roth each year to reach the top of the 12% or 22% bracket without spilling into the next, more expensive bracket. For example, if your taxable income is $70,000, you could convert up to $24,300 more that year and pay only 12% in federal tax. That's $2,916 in taxes on $24,300 moved to your Roth, where it will grow tax-free for the rest of your life. Repeat this each year until RMDs begin, and you could shift $120,000 or more into your Roth at historically low tax rates. Over a 20-year retirement, that could mean an extra $40,000 or more in tax-free withdrawals and a lower RMD burden, which helps keep your future taxes and Medicare premiums down. The key is timing. Every month you wait, your window narrows, and Congress could raise tax rates in the future. The most successful retirees I work with review their tax brackets every year, often in the fall, and make conversion decisions before December 31st. This gives them maximum control over their tax bill and retirement income. Strategy 2. Coordinating Roth withdrawals to manage Medicare premiums and Social Security taxation. Many retirees don't realize that the way you withdraw from your Roth IRA can directly impact your Medicare premiums and how much of your Social Security is taxed. Here's how the wealthiest and most strategic retirees use this to their advantage. Medicare uses your Modified Adjusted Gross Income, MAGI, from 2 years prior to set your premiums. If your MAGI crosses certain thresholds, $103,000 for singles or $206,000 for married couples in 2024, your Medicare Part B and D premiums go up, sometimes by thousands of dollars per year. By using Roth withdrawals instead of taxable withdrawals, you can keep your MAGI below these thresholds. For example, let's say you need $30,000 for a home renovation. If you take that from your traditional IRA, it adds $30,000 to your taxable income and could push you over a Medicare bracket. But if you take it from your Roth IRA, it doesn't count as taxable income and keeps your Medicare costs lower. I've seen retirees save $2,000 to $4,000 per year on Medicare premiums simply by coordinating withdrawals this way. The same principle applies to Social Security. Up to 85% of your Social Security benefits can be taxed if your combined income exceeds certain limits. Roth IRA withdrawals do not count toward these limits, so using your Roth strategically can reduce the tax on your Social Security and stretch your income further. Strategy 3. Multi-generational Roth planning, leaving a tax-free legacy. One of the greatest benefits of a Roth IRA is the ability to leave your heirs a tax-free legacy. But the rules have changed, and the Secure Act now requires most non-spouse beneficiaries to empty inherited Roth IRAs within 10 years. This makes it more important than ever to plan ahead, so your family receives the maximum benefit. Here's what I recommend for my clients who want to create a lasting legacy. First, if you intend to leave your Roth IRA to children or grandchildren, consider making larger Roth conversions during your own lifetime. You'll pay the taxes at today's rates, but your heirs will receive a larger tax-free account, which they can let grow for up to 10 years after your passing. For example, converting an extra $50,000 over 5 years at a 22% tax rate means paying $11,000 in taxes now, but potentially giving your heirs an account that could grow to $100,000 or more, all tax-free, before they're required to withdraw it. Second, coordinate your Roth IRA beneficiary designations with your overall estate plan. If you have multiple children or grandchildren, you can split the Roth IRA so each has their own 10-year window. For those with charitable intentions, remember that Roth IRAs can be left to qualified charities, allowing you to fulfill your philanthropic goals without your heirs paying taxes. Finally, keep in mind that Roth IRAs are protected from RMDs during your lifetime, but inherited Roth IRAs are not. Talk to your advisor about the best timing for conversions and withdrawals, especially if your heirs will be in higher tax brackets. Let's recap these advanced techniques. We've covered how to fill up lower tax brackets with strategic Roth conversions, how to coordinate Roth withdrawals to minimize Medicare premiums and Social Security taxes, and how to plan for a multi-generational tax-free legacy. Each of these strategies has powerful tax implications, but when used properly, they can help you keep more of your money, reduce your lifetime tax bill, and provide for your family. It's important to remember that the key to success is getting your timing exactly right. Every year, tax laws, income levels, and family circumstances can change. The retirees who get the most from their Roth IRA are those who review their plan annually, make small adjustments as needed, and work closely with a qualified advisor who understands the nuances of retirement tax planning. Building on what we just discussed, the next step is to map out your implementation timeline. When should you act? What should you do first, second, and third? And what deadlines or important dates should you keep in mind to make sure you're taking full advantage of these advanced Roth IRA strategies? But timing is crucial. Here's exactly when to take each step to maximize your results. Part 6. Your Roth IRA Action Plan, the 30, 60, 90-day timeline for securing your retirement. By now, you've learned how to avoid the most expensive Roth IRA mistakes and discovered advanced strategies for maximizing your tax-free income. But the real difference between retirees who succeed and those who fall short comes down to one thing: implementation. In my 30-plus years helping seniors optimize their retirement, I've seen that a clear, step-by-step timeline is what transforms good intentions into real results. Let's walk through exactly what to do over the next 30, 60, and 90 days to protect your Roth IRA and avoid that $89,000 mistake. Remember, this is educational content, not personalized financial advice. Before taking any action, consult with a qualified financial advisor who can tailor these steps to your unique situation. The first 30 days: foundations and fact-finding. Your first month is all about getting organized and gathering the information you'll need for smart, strategic decisions. Start by pulling together all your retirement account statements, Roth IRAs, traditional IRAs, 401ks, and any other accounts that might come into play. Make sure you have the most recent statements, as well as records of any past Roth conversions or contributions. Next, confirm your Roth IRA's 5-year rule status. Look for the exact date of your first Roth contribution and any conversions. Remember, the 5-year clock starts on January 1st of the year you made your first contribution or conversion. If you're unsure, call your financial institution and ask for written confirmation. I can't emphasize this enough. A misplaced date can cost you thousands in unexpected taxes. Within these first 30 days, map out your projected income for the current and upcoming year. List all sources: Social Security, pensions, annuities, RMDs, part-time work, or rental income. This will help you identify your current tax bracket and how much room you have for tax-efficient Roth conversions or withdrawals. Finally, review your Roth IRA beneficiary designations. If there have been any life changes, marriage, divorce, birth of grandchildren, or the loss of a loved one, make sure your beneficiaries are up to date. Many retirees find this is a good time to schedule a review with their estate planning attorney as well. Let me repeat that. Within the first 30 days, your goal is to get your financial house in order, confirm your Roth timelines, and review your income and beneficiary details. This groundwork sets you up for smart decisions in the coming months. The next 30 days. Days 31 to 60. Analysis, planning, and professional guidance. With your documents and numbers in hand, the next month is about analyzing your options and crafting your personalized Roth IRA plan. This is where you'll want to connect with a qualified financial advisor or tax professional, someone who understands the intricacies of Roth IRAs, tax brackets, Medicare premiums, and estate planning for retirees. Start by reviewing your current and projected tax brackets for the next 5 years. Ask your advisor to run projections. If you convert $20,000, $50,000, or $80,000 from your traditional IRA to your Roth this year, what will your tax bill look like? How will it impact your Medicare premiums, both this year and 2 years down the line. If you take a $15,000 Roth withdrawal for a home improvement or medical expense, what will that do to your taxable income and Social Security taxation? During this period, set up a Roth conversion plan, if appropriate. Decide on a target amount to convert each year, aiming to fill up your current tax bracket without spilling into the next. For example, if you're a married couple with $90,000 in taxable income and the 22% bracket tops out at $201,050, you might plan to convert up to $111,050 this year. Schedule conversions for the fourth quarter, ideally before December 15th, to ensure they're processed by year-end and count for this tax year. This is also the time to review your Social Security and Medicare situation. If you're approaching age 65, consider how Roth withdrawals or conversions might affect your Medicare premiums. If you're already taking Social Security, ask your advisor to project how different withdrawal strategies could minimize the taxes on your benefits. Finally, work with your estate planner to coordinate your Roth IRA with your will, trusts, and other legacy documents. The Secure Act's 10-year rule for inherited IRAs means timing and beneficiary choices matter more than ever. Let me pause and recap. By the end of day 60, you should have a clear Roth conversion and withdrawal plan, a strategy for minimizing taxes and Medicare premiums, and your estate plan aligned with your Roth IRA goals. The final 30 days. Days 61 to 90. Execution and review. Now comes the most important part, taking action. In these final 30 days, execute your Roth conversions, withdrawals, or beneficiary updates as planned. If you're making a Roth conversion, submit the paperwork with your financial institution and request written confirmation that the transaction is completed in the current tax year. For withdrawals, make sure you're following the 5-year rule and that the funds are coming from the correct bucket, contributions, conversions, or earnings, based on your strategy. If you're updating beneficiaries or estate documents, confirm with both your financial institution and your attorney that all paperwork is signed, dated, and filed. Many retirees find it helpful to create a simple checklist and mark off each step as it's completed. This not only keeps you organized, but also gives you peace of mind that nothing has fallen through the cracks. During this 30-day window, review your overall retirement plan. Are your income streams balanced? Are you on track to stay within your target tax bracket? Are there any upcoming life events, like a home sale, healthcare expense, or family milestone, that might change your needs? If so, adjust your plan accordingly and schedule a follow-up with your advisor to revisit your strategy at least once a year. Key deadlines and important dates to remember. December 31st. All Roth conversions must be completed by the end of the calendar year to count for that tax year. Don't wait until the last week. Processing delays can cost you an entire year's opportunity. April 15th. Deadline for making prior year Roth IRA contributions. If you're still eligible, this can be a last-minute way to boost your tax-free savings. Birthday milestones. Age 59 and a half, eligible for penalty-free withdrawals. Age 65, Medicare enrollment. Age 73, RMDs begin for traditional IRAs. Mark these dates on your calendar as they each trigger important planning windows. IRMA look-back. Remember, Medicare premiums are based on your income from 2 years prior. Plan Roth conversions and withdrawals with this in mind to avoid surprise premium hikes. Let's recap what we've covered. In the first 30 days, gather your statements, confirm your Roth 5-year status, and review beneficiaries. In the next 30 days, work with your advisor to analyze tax brackets, plan conversions and withdrawals, and update your estate plan. In the final 30 days, execute your strategy, double-check all paperwork, and set reminders for annual reviews. Even if you follow this timeline perfectly, you might encounter some common roadblocks, unexpected tax issues, processing delays, or changes in your personal situation. The most successful retirees are those who don't panic when challenges arise. Instead, they know how to troubleshoot, adapt, and stay on course. But even with the best plan, you might run into these common implementation challenges, and that's what we'll tackle next. Even if you follow this perfectly, you might encounter these common roadblocks. Part 7. Troubleshooting. Your Roth IRA plan. Overcoming the most common roadblocks. You've taken the time to build a thorough, step-by-step plan for your Roth IRA. You've mapped out your timeline, reviewed your tax brackets, and even set reminders for key deadlines. But if there's one thing I've learned in over 30 years of guiding retirees through these critical decisions, it's this. Even the best-laid plans can hit unexpected bumps along the way. The difference between retirees who succeed and those who stumble isn't perfection. It's knowing how to troubleshoot, adapt, and keep moving forward. This is educational content, not personalized financial advice. Please consult with a qualified financial advisor for your specific situation before making changes to your accounts. Let's walk through some of the most common implementation challenges I've seen, along with practical solutions and what-if scenarios to help you stay on track. Challenge 1. Tax surprises from unexpected income or market gains. You've carefully planned your Roth conversions to fill up your target tax bracket, but suddenly you receive an unexpected bonus, a large capital gain from selling an investment property, or even an inheritance. Suddenly, your taxable income for the year is much higher than anticipated. This can push your Roth conversion into a higher tax bracket, increase your Medicare premiums 2 years down the road, or even trigger the 3.8% Medicare surtax on investment income. What should you do? First, don't panic. The most successful retirees I work with always build a buffer into their Roth conversion plans. If you're planning to convert $60,000, consider converting only $50,000 to leave room for surprises. If the income windfall happens before you've completed your conversion, recalculate your new tax bracket before moving forward. If it happens after your conversion, speak with your tax advisor right away. Sometimes a qualified charitable distribution, QCD, or a strategic deduction can help offset the extra income and keep your taxes in check. Let me repeat that important point. Always leave yourself a margin for error and review your income picture one more time before executing any large Roth conversions. Challenge 2. Processing delays and missed deadlines. It's December and you're ready to execute your planned Roth conversion before the year ends. But your financial institution is swamped, paperwork gets delayed, or a processing error occurs. Suddenly, your conversion is pushed into the next tax year, costing you a full year of tax planning opportunity. This happens more often than you might think. In my experience, the most prepared retirees act early, submitting Roth conversion requests no later than December 1st each year. If you're using a smaller or less tech-savvy financial institution, give yourself even more lead time. Always request written confirmation of your transaction and check your online account for processing status. If something goes wrong, contact your advisor and the institution immediately. If the worst happens and your conversion is delayed, don't get discouraged. Adjust your plan for the new year and consider making 2 smaller conversions in the following year if your tax bracket allows. The key lesson: don't wait until the last minute, and always confirm your transactions are processed in the correct tax year. Challenge 3. Medicare premium shocks from prior year income. You've executed a smart Roth conversion, but 2 years later, you receive a notice from Social Security. Your Medicare Part B and D premiums are going up because your income from 2 years prior was higher than the IRMA thresholds. This can feel like a punishment for good planning, but it's actually a common side effect of Roth conversions. Here's what you can do. First, understand that IRMA adjustments are recalculated each year. If your income drops in the following year, your premiums will also decrease. If the spike in income was due to a one-time event, such as selling a home, taking a large IRA distribution, or converting a large amount to a Roth, you can file Form SSA 44 with Social Security to request a reduction in your Medicare premiums. This form allows you to explain a life-changing event and, in many cases, have your premiums adjusted downward. The most successful retirees I work with are proactive. They track their income relative to IRMA thresholds every year, and they weigh the long-term benefits of Roth conversions against the short-term cost of higher Medicare premiums. Often, paying a bit more for 1 or 2 years is worth the tax-free growth and lower RMDs in the long run. Challenge 4. Family disputes or confusion over beneficiary designations. You've carefully updated your Roth IRA beneficiary designations, but after your passing, your heirs discover conflicting information, outdated forms, or confusion about how to handle the inherited Roth. This can lead to family disputes, legal costs, or even unnecessary taxes if the account isn't distributed correctly within the Secure Act's 10-year window. To prevent this, communicate your intentions clearly with your beneficiaries and your estate planning attorney. Provide copies of your beneficiary forms to your heirs and keep them with your will and other important documents. Review these forms annually, especially after any major life event, and confirm with your financial institution that their records match your wishes. If you have a trust, ensure it's properly structured to receive Roth IRA assets and that your beneficiaries understand the rules for inherited Roth IRAs. In my experience, the retirees who leave the smoothest legacy are those who involve their family in the planning process, educate them about Roth IRA rules, and make sure all documentation is clear and accessible. What if? Scenarios and solutions. What if you discover you've already made a withdrawal before the 5-year rule is satisfied? Speak with your tax advisor immediately. You may need to file amended tax returns and pay the tax on any earnings withdrawn, but you can avoid further penalties by correcting the error quickly. What if you realize you've named the wrong beneficiary, but the account owner has passed away? In most cases, beneficiary designations are legally binding, but an attorney may be able to help correct errors if there is clear evidence of intent or fraud. What if tax laws change? This is one of the most common concerns I hear. The truth is, Congress can and does change the rules. The best defense is to stay informed, review your plan annually, and work with an advisor who keeps up with legislative changes. In my practice, we review every client's Roth IRA strategy each year after tax season and again in the fall, so adjustments can be made before year-end deadlines. Let's recap what we've covered in this section. We've addressed how to handle unexpected income, avoid processing delays, manage Medicare premium shocks, and prevent family disputes over your Roth IRA. We've discussed what to do if you make a mistake and how to prepare for changes in tax law. The most successful retirees I work with aren't those who never encounter problems. They're the ones who know how to respond, adapt, and keep their plan moving forward. Once you master this foundation, troubleshooting, adapting, and staying proactive, you're ready for the next level. That's where you can start to truly optimize and scale your Roth IRA strategy for maximum long-term benefit. Once you master this foundation, you're ready for the next level. Part 8. Next Level. Roth IRA Mastery. Scaling, optimizing, and securing your legacy. If you've made it this far, you're already well ahead of most retirees. You've learned to avoid the $89,000 Roth IRA mistake, built a timeline for action, and mastered troubleshooting the most common roadblocks. But in my 30-plus years of working with high net worth retirees, I've found that those who achieve lasting security and leave a meaningful legacy are the ones who go beyond the basics. They don't just implement a plan, they optimize, scale, and adapt it for the long haul. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor before making changes to your accounts or strategies. Your situation is unique, and your plan should be too. Let's talk about how you can take your Roth IRA strategy to the next level, maximize your results, and ensure your wealth works for you and your family for decades to come. First Annual Roth IRA Optimization Reviews, fine-tuning for maximum efficiency. The most successful retirees treat their Roth IRA like a living, breathing part of their financial life. That means committing to an annual review, ideally every fall before the year-end deadlines. During these reviews, you'll want to recalculate your tax bracket for the current and upcoming year. Even a modest change in income or tax law can open up new Roth conversion opportunities or close off others. Assess your healthcare needs and projected Medicare premiums. If you anticipate a spike in healthcare expenses, it might make sense to take a larger Roth withdrawal in a low-income year. Revisit your Social Security and pension income. If you plan to delay Social Security, you might have several years of low taxable income, prime time for Roth conversions at historically low rates. In my experience, retirees who do this annual check-in often find $10,000 to $30,000 in additional tax savings over a decade simply by making small, data-driven adjustments each year. Let me repeat that. A one-hour review each year could save you thousands and help you avoid costly surprises. 2. Scaling your Roth strategy, layering advanced techniques. Once you have the fundamentals in place, it's time to layer in advanced strategies that scale with your wealth and changing needs. Here are 3 powerful techniques many affluent retirees use. Roth conversion, laddering. Instead of converting a lump sum, spread conversions over 5 to 10 years. Laddering your conversions to fill up lower tax brackets each year. For example, if you're in the 22% bracket, convert just enough each year to stay below the 24% threshold. This approach can save $20,000 or more in taxes compared to a single large conversion. Dynamic withdrawal sequencing. Adjust your Roth traditional IRA and taxable account withdrawals each year based on market performance, tax brackets, and healthcare needs. In years when the market is down, you might take more from your Roth to avoid selling investments at a loss in your taxable accounts. In strong market years, you can rebalance by taking more from your traditional IRA, keeping your overall tax bill low. Qualified charitable distributions, QCDs. Coordination. If philanthropy is part of your legacy, coordinate QCDs from your traditional IRA with Roth conversions. By giving up to $100,000 annually directly from your IRA to qualified charities, you can reduce your RMDs and taxable income, freeing up more room for Roth conversions at lower rates. Industry insiders know that combining these strategies, laddering, dynamic sequencing, and charitable planning, can dramatically increase both your after-tax retirement income and the size of your legacy. 3. Long-term Roth IRA considerations. Protecting against future risks. Retirement isn't static, and neither are tax laws or family circumstances. The retirees who thrive for 20 or 30 years are those who plan for change. Here's what to keep in mind. Legislative changes. Congress regularly debates changes to retirement account rules, tax brackets, and estate taxes. Stay informed and work with an advisor who keeps up with these changes. For example, if rumors of higher income tax rates become reality, accelerating Roth conversions in the next few years could save you thousands. Healthcare and long-term care planning. As you age, healthcare costs can become your single largest expense. Roth IRAs are uniquely valuable because withdrawals don't affect your Medicare premiums or Social Security taxation. Consider earmarking a portion of your Roth for unexpected medical or long-term care needs. Multi-generational legacy planning. The Secure Act's 10-year rule means your heirs must empty inherited Roth IRAs within a decade. To maximize the benefit, consider splitting your Roth among multiple beneficiaries or combining Roth strategies with life insurance or trust to spread your legacy and reduce taxes for the next generation. One of my clients, a retired physician, revisited his Roth strategy every year. Over a decade, he shifted $400,000 from his traditional IRA to his Roth, always staying in the 22% bracket. When he passed, his two daughters each inherited $300,000 in Roth assets. By letting those funds grow for the full 10 years before withdrawing, each daughter ended up with nearly $450,000, tax-free enough to pay off mortgages and fund college for his grandchildren. That's the power of long-term next-level planning. 4. Proactive scam protection, keeping your Roth safe. As your Roth IRA grows, so does the risk of being targeted by scams or unscrupulous advisors. The most successful retirees I work with set up additional safeguards. Use only well-known, reputable custodians for your Roth IRA accounts. Set up account alerts for all transactions, especially large withdrawals or beneficiary changes. Share your plan with a trusted family member or attorney so someone can help monitor for suspicious activity if your health declines. Let me recap what we've covered. Annual Roth IRA reviews, conversion laddering, dynamic withdrawal sequencing, QCD coordination, legislative awareness, multi-generational legacy planning, and scam protection. Each of these advanced steps helps ensure your Roth IRA not only avoids costly mistakes, but delivers the tax-free security, flexibility, and legacy you've worked so hard to build. If you apply even a few of these next-level strategies, you could see tens, sometimes hundreds, of thousands of dollars in additional after-tax income and legacy value over your retirement. And you'll sleep better at night, knowing you've built a plan that can weather changes in tax law, market conditions, and family circumstances. So far, we've built your Roth IRA from the ground up, avoiding pitfalls, implementing a smart timeline, troubleshooting challenges, and now optimizing for the long haul. But there's one final step, bringing all these lessons together into a simple, actionable summary you can use to guide your next conversation with your advisor and your family. What I'm about to show you will surprise even experienced investors. Over the past hour, we've covered a tremendous amount of ground together. We've gone far beyond the surface, digging into the exact Roth IRA mistake that quietly destroys up to $89,000 of retirement wealth for American seniors each year. Let's briefly recap the 8 key insights from our journey. First, we identified how a single misstep with Roth IRA, withdrawals, or conversions can trigger devastating taxes and penalties, often when you least expect it. Second, we explored the 5-year rule and why misunderstanding it is the most common and expensive error. Third, we examined the dangers of overconverting in a single year and how that can spike your tax bill and Medicare premiums. Fourth, we discussed how outdated beneficiary designations can derail your legacy and cost your heirs dearly. Fifth, we challenged the old Roth last advice, showing why strategic withdrawals can save you thousands over time. Sixth, we exposed the risks of scams and too-good-to-be-true promises targeting retirees' Roth accounts. Seventh, we introduced advanced strategies like Roth conversion laddering, dynamic withdrawal sequencing, and qualified charitable distribution coordination. And eighth, we outlined a clear step-by-step implementation timeline to bring all these concepts together. This isn't just entertainment, this is valuable financial education. The knowledge you've gained could easily save you tens of thousands of dollars, reduce your tax burden, and help you leave a more meaningful legacy. In my decades of helping retirees optimize their finances, I've seen these principles work for thousands of people across all market conditions. What separates financially secure retirees from those who struggle is usually knowledge and implementation, not luck or timing. This represents decades of experience distilled into practical guidance that you can act on right now. Now that you understand each piece, here's how they work together. When you combine accurate tracking of your 5-year rule, smart Roth conversions within your optimal tax bracket, coordinated withdrawals, annual beneficiary reviews, and long-term optimization, you create a comprehensive retirement strategy with a compound effect. For example, a retiree who follows this complete approach, converting $40,000 per year over 5 years while staying under key Medicare and tax thresholds, taking strategic withdrawals in low-income years, and keeping beneficiary designations updated, can often add $60,000 to $120,000 in after-tax, spendable income over a 20-year retirement. And that's before considering the tax-free legacy you can leave for your children or grandchildren. This is why wealthy retirees often outperform those with more starting capital. They don't leave money on the table, and they avoid the silent killers of unnecessary taxes and penalties. Let me emphasize this important point. When all these strategies work together, your Roth IRA becomes not just a tax shelter, but a flexible, resilient pillar of your retirement security. So, what should you do next? Here are 4 specific steps to take within the next 30 days to get on the right track. Step 1. Assessment phase. First week. Start by gathering these 3 essential documents: your most recent Roth IRA statement, your latest tax return, and a list of all other retirement accounts. Calculate your current Roth IRA 5-year rule status using the method we discussed. Identify the exact start date for each contribution and conversion. Finally, pinpoint your biggest opportunity area. Is it optimizing conversions, fixing a beneficiary, or coordinating withdrawals with Social Security? Step 2. Planning phase, second week. Create your personalized retirement income timeline based on your age, current income sources, and goals. Research the specific strategies we discussed, such as Roth conversion laddering or dynamic withdrawal sequencing, that apply to your situation. Document your current withdrawal and conversion approach, then compare it to what you've learned here. Where are the gaps? What needs to change? Step 3. Professional consultation, third week. Schedule a meeting with a qualified financial advisor who specializes in retirement income and tax planning. Bring these key questions. How can I optimize my Roth conversions for my tax bracket? Are my beneficiary designations up to date with the Secure Act rules? How will my Roth withdrawals affect my Medicare premiums and Social Security taxes? Verify that your advisor understands these advanced Roth strategies. Don't settle for generic advice. Step 4. Implementation begins, fourth week. Start with the lowest risk, highest impact change. First, often this means updating beneficiaries or confirming your 5-year rule. Next, set up the systems and accounts needed for your new strategy, whether that's automatic withdrawals, Roth conversion paperwork, or account alerts. Begin tracking your progress with simple metrics: annual tax savings, Medicare premium brackets, and projected legacy value. Remember, the goal is steady progress, not perfection. Now, let's talk about risk mitigation and realistic expectations. Remember, every financial strategy carries some level of risk, whether it's market volatility, legislative changes, or simply the unexpected. The goal isn't perfection, it's optimization based on your unique situation and risk tolerance. Most successful retirees implement these changes gradually over 6 to 12 months, reviewing and adjusting as needed. Don't let perfectionism prevent you from starting with small improvements. These aren't get-rich-quick schemes. They're proven, long-term strategies that have stood the test of time. While the steps we've discussed can dramatically increase your retirement security, always consult with a qualified financial and tax professional before making significant changes. Every individual situation is unique, and what works for one person may not be optimal for another. Past performance doesn't guarantee future results, and tax laws can and do change. You're now part of a community of informed retirees who refuse to settle for average. The journey to financial optimization is ongoing. Markets shift, laws evolve, and your needs may change. Continue your education by staying up to date on retirement planning developments, whether that's through videos like this, trusted newsletters, or conversations with your advisor. Share your success stories and learn from others who are implementing these strategies. You'll be amazed at the collective wisdom within this growing community. If this video helped clarify your retirement planning strategy, please give it a thumbs up so others can benefit as well. Share your biggest takeaway in the comments. Was it the 5-year rule, conversion laddering, or something else? Which strategy will you implement first? Subscribe for more in-depth retirement planning guidance that could save you thousands. Most importantly, take action on what you've learned. Your future self, your spouse, and your family will thank you. Remember, this has been educational content designed to inform your decision-making. Every individual's financial situation is unique, and you should always consult with qualified financial, tax, and estate planning professionals before making significant changes. A qualified advisor can help you customize these strategies for your specific situation. Tax professionals can ensure you're maximizing benefits while staying compliant, and estate planning attorneys can help with the legal aspects we discussed. The tax implications we covered may change based on future legislation, so stay vigilant and review your plan annually. After helping retirees navigate multiple market cycles, I can tell you, the most successful clients I've worked with consistently apply these principles, review their plan every year, and never stop learning. Imagine the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Sleep better tonight, knowing you have a clear plan for your financial future. Your children and grandchildren will benefit from the wise decisions you make today. Maintain your independence by taking control of your financial destiny. You've worked too hard to accept anything less than optimal planning. The sooner you implement these strategies, the more time they have to work in your favor. Every month you delay is a month of potential optimization lost. The cost of inaction often exceeds the cost of making imperfect but informed decisions. You now have knowledge that many retirees never acquire. Use it to your advantage. What surprised you most about the strategies we covered today? Which approach best fits your current retirement situation? Have you already implemented any of these strategies? Share your experience below. What's your biggest concern about retirement planning that we should address next? If you could ask a financial advisor one question based on this video, what would it be? You'll know you're on the right track when your financial stress decreases and you have clear answers to the questions that used to keep you awake. The goal is progress, not perfection. Small improvements compound over time. Measure your success by increased confidence in your financial decisions. If you're ready to take control of your Roth IRA and avoid the $89,000 mistake, start today. Your future self and your family will thank you.